This video is presented by Fortune.
The world of digital finance witnessed an extraordinary spectacle on Wednesday, May 21, 2025. Bitcoin, the undisputed king of cryptocurrencies, embarked on a breathtaking ascent. It climbed to an unprecedented all-time high, touching the remarkable figure of $109,722. This peak was reached just before 1 p.m. Eastern Time, sending ripples of excitement and speculation across global markets. Investors and enthusiasts alike watched with bated breath, wondering if this new pinnacle signaled a sustained bull run or merely a prelude to a more volatile chapter. The digital asset had once again proven its capacity for explosive growth, capturing headlines and dominating financial discussions worldwide. However, the euphoria was short-lived, a fleeting moment in the grand, often unpredictable narrative of cryptocurrency markets. Within mere minutes of reaching this historic milestone, Bitcoin's trajectory took a sharp, almost violent turn. The price began to tumble, a stark reminder of the inherent volatility that characterizes these digital assets. It was a dramatic reversal, demonstrating how quickly fortunes can shift in this high-stakes arena. For those who had just entered the market at its peak, the sudden downturn was a harsh introduction to the risks involved. The digital gold rush, it seemed, came with its own set of perils, demanding a steely resolve from its participants. The descent was swift and significant. Bitcoin's value plummeted to $106,307 in a remarkably short period, erasing thousands of dollars from its price per coin. By the time the markets began to process this rapid fluctuation, the price had slightly recovered, settling at $107,191 at the time of reporting later that day. This roller coaster ride, all within a few hours, underscored the speculative nature that still heavily influences cryptocurrency valuations. Such rapid price movements are not uncommon, but their scale on this particular day was noteworthy. It served as a potent illustration of the market's sensitivity to various underlying factors and investor sentiment, which can change in an instant. This event was more than just a numerical shift. It was a lesson in market dynamics. The rapid ascent to an all-time high, followed by an equally rapid correction, highlights the delicate balance of supply, demand, and investor confidence. Observers noted that such volatility, while unsettling for some, is considered by seasoned traders to be part of the crypto landscape. The market's behavior on May 21st provided a vivid case study in how quickly market sentiment can pivot. Understanding these dynamics is crucial for anyone looking to navigate the often turbulent waters of cryptocurrency investment, where high rewards often come hand in hand with significant risks. The primary catalyst identified for this abrupt market downturn was external to the cryptocurrency sphere itself, originating from the traditional financial markets. A notably weak 20-year Treasury auction conducted by the U.S. Treasury was pinpointed as the trigger. This auction's poor performance led to a significant and sudden spike in bond yields. In the complex interplay of global finance, higher bond yields typically signal a flight to safety. Investors tend to perceive government bonds as less risky alternatives, prompting them to divest from higher-risk assets, a category that prominently includes cryptocurrencies. This shift reflects a broader reevaluation of risk appetite in the face of changing economic indicators. The connection between U.S. bond yields and the cryptocurrency market, while sometimes debated, was starkly evident on this occasion. When yields on safer assets like Treasury bonds rise, the appeal of volatile investments diminishes. Cryptocurrencies, known for their potential for high returns but also for their significant price swings, become less attractive to investors seeking stability. This inverse relationship played out textbook style. The surge in bond yields created a gravitational pull, drawing capital away from assets perceived as speculative. It's a classic risk-off scenario, where caution overtakes the pursuit of aggressive growth, impacting markets far beyond traditional stocks and shares. The shockwaves from Bitcoin's downturn did not take long to propagate across the wider cryptocurrency ecosystem. Ethereum, the second-largest cryptocurrency by market capitalization, and a cornerstone of the decentralized finance world, mirrored Bitcoin's fall. Within minutes of Bitcoin's plunge, Ethereum's price dropped by a significant 5%, falling to $2,480. This sympathetic movement is a common phenomenon in the crypto markets, where Bitcoin often acts as a market leader, its trajectory heavily influencing investor sentiment towards other digital assets. Ethereum's dip highlighted the interconnectedness of these digital currencies and the systemic risk present. Similarly, Dogecoin, a cryptocurrency that initially started as a meme but has since garnered a substantial following and market cap, also experienced a notable decline. The popular token dropped 5.6% from its peak to its trough during this period of market agitation. At the time of reporting, Dogecoin was trading at 22.6 cents per token. This reaction from Dogecoin, along with Ethereum, demonstrates that the impact was broad-based, affecting various types of cryptocurrencies, regardless of their underlying technology or community focus. The market acted in concert, driven by the overarching shift in risk perception triggered by the movements in the traditional bond market, underscoring a shared vulnerability. Analyzing Bitcoin's historical performance provides valuable context for understanding its behavior on May 21, 2025. Contrary to some early narratives that posited Bitcoin as a digital gold or a safe haven asset, its trading patterns have often shown a strong correlation with growth stocks. This means that during periods of economic optimism and market upswings, Bitcoin has tended to perform well, much like companies focused on future growth. However, this correlation also implies a shared vulnerability during downturns. The data over the past 3 years, when comparing Bitcoin's price movements with an index like the Vanguard Growth Index ETF, illustrates this tendency quite clearly. This pattern suggests that Bitcoin is not typically a refuge when broader markets experience a recession or a significant drop. For instance, during the market fall observed in late 2021 and extending into 2022, Bitcoin's value did not hold firm or appreciate as a traditional safe haven asset like gold might. Instead, it largely tracked the downward trend of riskier assets. This historical precedent is crucial for investors to consider, as it challenges the notion of Bitcoin as an uncorrelated asset class that can reliably hedge against economic instability. The events of May 21, therefore, align with this established pattern of behavior rather than deviating from it. The recent spike in bond yields and the subsequent crypto market drop have amplified existing concerns within financial circles. Analysts are increasingly worried that the bond markets might be signaling a broader warning about economic health. A sudden jump in yields can indicate that investors perceive rising risk even in U.S. Treasuries, traditionally considered among the safest investments. This could stem from various factors, including fears that the U.S. dollar is losing its safe haven status globally, or perhaps an anticipation of higher future interest rate hikes by the central bank, possibly driven by inflationary pressures, which themselves could be exacerbated by new tariffs. These signals from the bond market are not to be taken lightly, as they often precede periods of heightened economic uncertainty or even distress. If the underlying cause for rising yields is a growing risk premium on government debt, it points to deeper systemic issues. For example, if the market anticipates that inflation will surge due to factors like trade tariffs, it will demand higher compensation, or yields, for holding long-term debt. Such an environment makes speculative assets like cryptocurrencies particularly vulnerable. The intricate dance between inflation expectations, interest rate policies, and investor sentiment creates a complex backdrop against which digital assets must navigate. The implications of holding cryptocurrencies during periods of economic uncertainty, such as the one potentially signaled by the recent bond market activity, are significant. These digital assets, characterized by their high volatility and speculative nature, can become particularly undesirable for investors when economic storms gather. If the U.S. economy were to enter a tariff-induced recession, for instance, accompanied by rising interest rates to combat inflation, the fallout could be substantial. In such scenarios, capital typically flows from high-risk, high-reward assets towards safer, more stable investments. Cryptocurrencies, despite their technological innovations, often fall into the former category in the eyes of mainstream investors. Consider a scenario where global trade tensions escalate due to tariffs, leading to slower economic growth and higher prices for consumers and businesses. A stagflationary environment. Central banks might respond by increasing interest rates to curb inflation. This combination of slowing growth and tightening monetary policy creates a challenging environment for assets that don't generate intrinsic cash flows, like many cryptocurrencies. Investors might prioritize capital preservation over speculative gains, leading to significant outflows from the crypto market. The allure of potential high returns from digital assets can quickly fade when faced with the palpable risk of substantial losses in a contracting economy. Historically, Bitcoin and other cryptocurrencies have not demonstrated the characteristics of a safe haven asset during broad market downturns or recessions. Instead, they have often behaved more like technology stocks or other growth-oriented investments which tend to suffer when economic prospects dim. The events of May 21, 2025, where a shift in bond yields triggered a sharp crypto sell-off, serve as a fresh reminder of this correlation. Therefore, investors holding significant portions of their portfolios in cryptocurrencies face heightened risks if the economic outlook continues to darken. Diversification and a careful assessment of risk tolerance become even more critical in such times. Ultimately, the decision to hold cryptocurrencies during unstable economic conditions hinges on an individual's investment strategy and risk appetite. However, the prevailing sentiment suggests caution. The Motley Fool Stock Advisor analyst team, for example, did not include Bitcoin among their 10 best stocks for investors to buy at the time of the May 21 article, reflecting a degree of skepticism from some traditional investment advisors. If the bond markets are indeed sounding an alarm about future economic stability, the appeal of highly volatile assets like Bitcoin, Ethereum, and Dogecoin may diminish further for a broad range of investors seeking to protect their capital in uncertain times.
Markets move, coins arise, FundForge brings you clear insights. Build your fortune, wise and strong, where your wealth truly belongs.